Hello everyone, Greg Miller here from Spinoff InvestingSimplified.com, here to give you a brief update on the Honeywell spinoff Garrett Motion Incorporated. This Honeywell spinoff is supposed to occur on October 1st, 2018. Date of record will be September 18th, 2018. Just a quick contrast between Honeywell and Garrett Motion. Honeywell is a diversified industrial conglomerate. The management has expressed concerns over the past couple of years that they want to become a software industrial conglomerate. Their 2017 sales were $40.5 billion and their earnings were $5.3 billion. This particular portion of Garrett made up only $3.1 billion of the sales, and they have a loss of $101 billion. Honeywell does have a dividend policy that typically provides dividends of somewhere between 1.5 and 2% yield. And the new company, Garrett Motion, will not anticipate having any dividend policy at the beginning of its life. Honeywell does have shares outstanding of 743 million shares. That means that we'll have a spin-off ratio of 10 to 1 when Garrett comes into existence, with having approximately 75 million shares. When we look at outstanding debt for these two companies, Honeywell has approximately $42.2 billion in debt, and Garrett Motion will have about $5 billion in debt upon this completion of the spinoff. This means that they will be highly leveraged in comparison to their parent, because they're taking on about 1/8 of the company's overall debt load. Moving on to the management team incentives. We see here that CEO, CFO, CIO, and Senior Vice President of the integrated supply chain will all receive sign-on bonuses, restricted stock units, upon vesting in years 3 and 4 for all of them except the CFO, who receives his on years 1 and 2 of his employment with the company. All the senior leadership receives equity award eligibility based on how well they perform over the past year. This means that they typically will be incentivized to meet the same expectations that a shareholder would. Of note, approximately 20% of Garrett's new shares will be set aside for these management team incentives. Moving on to valuation, the expected debt load for this company is just shy of $5 billion, and their anticipated cash balance is just under $100 million. They will have expected operating cash flows of somewhere between $100 and $300 million, with $300 million being the more likely scenario, and their expected operating earnings will be somewhere between $370 and $474 million. I expect them to typically have about $400 million in operating earnings each year. And then their peer enterprise value over operating cash flow ratio is currently 27.8, and the peer enterprise value over operating earnings ratio is approximately 20. That means their expected price range will be somewhere between $34 and $46 a share, and my expectation is somewhere in about the $38 to $46 per share range. In my opinion, this Garrett spinoff has several things going for it. They have stark contrast with their their industrial conglomerate parent Honeywell, and that they will also have an opportunity of differentiating themselves through dividend policy and also the size and number of shares that they have. This company is very specific to the automotive market, and so it does have an opportunity in that area as well. It is, however, highly leveraged, and therefore it can maintain some inherent risk according to its peers and according to the industry overall. And a downturn in the automotive market or the worldwide economy in general could adversely affect this company. Therefore, I'm setting my entry price below $24 a share to provide an adequate margin of safety. This analysis was brought to you by Spinoff InvestingSimplified.com. Thanks for watching.